We are going to cover the leverage and what is the margin and how can we avoid blowing up or blowing out our accounts. Actually, this topic it's part of as we have mentioned before, risk management because leverage it's as we can say it's a double weapon. So you can benefit from leverage and you can lose from leverage. Okay, the idea is how to use it professionally. This is what actually I'm looking to deliver to you guys. Okay, before we get started, as we know, I just want you to write on the chat whether are you beginner, intermediate, or in your advanced level of trading journey. So we got to know what we should speak about. Advanced, all right, intermediate, beginner, intermediate, beginner. All right, beginner, intermediate, very beginner, no worries. Okay, so okay, I got it. So we have a mix. We have advanced, we have intermediate, and we have the majority are beginners. So that's easy. Let's get started. So I'll just beginner to intermediate, no worries. Thank you so much, guys, for your reply. So, in this workshop, we are going to cover the leverage, the margin call, how to optimize leverage for different market conditions, and how to avoid over leveraging and account blowouts, which is the most important thing that we are going to speak about is how to avoid blowing up your account. Okay. Now, we need to understand what is leverage. But before we jump to what is leverage and how can we use the leverage and what are the calculations of the leverage and so on, I just want to give you a brief about something in trading related to as well related to leverage. So allow me just 5 minutes from your time. I'm going to explain something that is on the side, and then we are going to cover back or to come back to our session, right? So if I want to explain what is the leverage, you need to understand that leverage, it is something that is given to you by the broker. Okay, it is something that is given to you by the broker to help you to open larger positions. What does this mean in a simple term? I'll explain. So, for example, you have $100. We have a trader here or someone, let's forget about trading right now, who has $100 in his pocket. And this guy actually, he like, for example, let's say a t-shirt, okay, or a watch or whatsoever. And that watch actually equals, or this t-shirt actually equals, let's say, $500, right? Okay. Now, the whole idea is this person, he cannot afford to get this t-shirt, right? Because he is missing $400, right? He's missing how much? He's missing $400. So what this guy is gonna do, simply, he might borrow, okay, from his friend. He might borrow from a bank in order to what? In order to get the t-shirt. That's it, right? So what happens here is a sort of borrowing, right? The difference between the borrowing and leverage, it's a very simple thing. Now, if you are going to borrow from a bank, you are going to pay interest for the bank, right? Some EMI, some installment for the bank in order to repay the 400. So you are not going to repay 400. You are going to repay 400 plus interest. Okay? That's number one. Now, when it comes to trading, if there is a person, okay, who has, let's say, $100 in his account, and this person, he would like to buy, for example, gold. Okay. Now we know that the price of the gold per ounce for now, I didn't check, but is $5,000. Now for $100, you cannot buy a $5,000, right? So what you're gonna do, you are going to borrow, but this time not from the bank. Okay, you are going to borrow from your broker himself. So you open a trading account with a broker, right? Okay, so this is your broker. Okay, so the broker is gonna give you the remaining amount. The broker is gonna give you the remaining what? The remaining amount. Okay, but you are not obligated to pay any interest for your broker. You are not obligated to pay any interest for what? For your broker. Okay, so at that point of time, the broker is gonna give you the money. Okay, but you only own from the 5,000 in order to buy the gold, you are only, this is your equity, $100. The remaining, the remaining is as if it's a loan, but you are not paying any interest on that. Okay? The broker is only helping you or supporting you just to do the trade, just to execute the trade. Now, here is the trick. Okay? First of all, before we jump to anything else, did you get this? 5,250. Okay, that's great. Right? Okay. So, did you got the definition of the leverage? So, what is the leverage? All good? Thumbs up? Okay, that's clear. That's very simple. That's the definition of leverage. Okay? Now, there is a very huge issue here, which is what? In leverage, this person, he was only having $100, right? And the broker supported him and gave him 4,900 to buy a gold that worth $5,000. Now, if this person, okay, took a buy position and the gold has reached to 5,250, so this guy has made a profit, right? He has made an extra $250, right? But the issue is when it comes to losses. Now, originally, this person shouldn't be exposed to the risk of gold. Because any trading, any asset classes that we are going to trade, whatever it is, currencies, indices, crypto, gold, silver, anything in the life, it has a risk. And this risk is known as market risk. So you have $100. This $100 actually cannot expose you to the risk. You cannot do anything with that. But once you took the leverage from your broker, now you get the access to risk. Okay? So either the risk is going to be in your favor or it's going to be against you. As we know, the gold is doing like this right now, right? Now it's going like this. Maybe in a few months, in a few weeks, it's going to smash. I don't know. No one knows, right? Now, the idea is your $100, okay, cannot actually cope up with these fluctuations. It cannot, because just a slight movement to the down, the $100 is over. But now you are trading with $5,000 that you just own $100 of it. So originally you shouldn't be exposed to this risk. But because you are taking leverage, now you are exposing yourself to the market risk. Okay? So if you as a trader think that leverage is bad or you are losing because of leverage, no, the reality is not, because the market is the same with leverage or without leverage. Think about it like this. Nothing has changed if there is a leverage or you are using a high leverage or if you're not losing leverage. Okay? The price of the gold still change, right? This is number one. Number two, if you're losing because of leverage, actually you could have made billions of dollars or millions of dollars or thousands of dollars also because of leverage. And this is why CFDs industry it's now very popular. Why? Because I don't have to have like $200,000 to trade in the market. You just need $1,000. But the $1,000 can be like, for example, 10,000. It can be converted to 20 to 50 over a year or months or whatsoever. But the leverage is supporting you to get into this trading. Okay. Without leverage, believe me, you don't gonna have the access to the chart. You are not gonna have access to the trading. You are not gonna have access to the gold or to the volatility in the market, which makes money. Okay. But people think and they start to blame the leverage. I took a leverage and this is why I lost. No, unfortunately, no. The reason is yourself. You didn't manage the risk or you didn't understand what is the leverage, right? So that's the whole idea of leverage. Leverage, it's a tool just to let you open more positions when it comes to trading. And professional traders will know how to utilize this in their own favor, right? So this is the definition of leverage. So if you have $100 and you want to trade gold at $4,200, so you deposited $100 at the broker account, okay, and you choose a leverage of 1 to 1. So brokers usually shows the leverage as a 1 to 1. So what does it mean? $1 of your money equals $1, right? So $100 times one, it's $100. So if you try to buy gold at $4,200, unfortunately, this is not going to work because you don't have a sufficient fund. But if you deposited $100 in the broker account, and then instead of choosing 1 to 1, you choose a 1 to 100. So what does this mean? Every $1 of your account, it's gonna be multiplied by 100. So you have 100 times 100, right? So you have $10,000, okay? It's not yours, as if you have $10,000, right? So if you try to open a position in a gold that is price is $4,200, then it's gonna work. But now here, the broker didn't allow you. The broker said you don't have that capital. You cannot take risk. But once you choose leverage 100% or 1 to 100, it means that you know there is a risk. Okay, so I'll give you the money, and this is your responsibility, right? So you exposed yourself to risk. So if you lost, don't blame the leverage, okay? Or don't even blame the market. The market, it's a volatile market all the time, okay? Is that clear, everyone? All good? Let me check. Very good. Okay, uh, now, which leverage should I choose? Okay, so there are some brokers, okay, that gives 1 to 500. Theo Prime gives 1 to 500. You can reduce it to 1 to 100, 1 to 200, or some brokers gives 1 to 2,000. Some brokers gives unlimited leverage, right? Now, which leverage should I choose? If you are a professional trader, I would say professional trader. And a professional trader has a lot of, it's a general term, okay, with a lot of specifications. Believe me, the professional traders, they choose 1 to 100, right? Because in some countries it's limited to 1 to 30. Yes, I agree with you, 100%. Yeah, it's not everywhere. Now, if you go to any funding firm, okay, that provides funded accounts, you will find all of the funding firms, okay, it is giving two type of accounts. One that provides a leverage to 1 to 30, and the other one provides a leverage of 1 to 100, not more than this. You cannot find any funding firm that's providing 1 to 500. You know why? Because funded accounts, it is made for professional traders, for pro traders, right? So you will make a profit, you will achieve the target, you are not gonna go on the drawdown, you are not gonna breach any violation, you are going to trade, you're not gonna trade on the news, okay? And you're still gonna make profit with 100 leverage, 1 to 100. Not a 1 to one to 500, not a one to 1,000, not a one to 2,000, because everyone who's saying, okay, let me choose the highest leverage, I have to use it. It's an opportunity. It's not an opportunity because if you are not able to understand how the leverage can harm you or take your money quickly, then what's the point, right? Leverage changes according to trading investment with some brokers. Yes, 100%. So also there are some brokers who who changing the leverage during the volatility of the market. If there is a high time volatility, like for example, there are CPI news or FOMC news or interest rate decisions and so on, they change the leverage. This is something that we do not recommend, like to trade with a broker who is changing the leverage according to the volatility of the time. Okay, the leverage should be fixed. If you choose 100, it should be 100. If you choose 30, it should be 30, right? You the only one who change it from your end. Okay? Okay. Now, okay, leverage is a tool, it's not a weapon, and we understood this idea. Now, most traders do not lose because of leverage. They lose because of the position sizing and the no risk control. Now, here is the thing that I want to speak about it. Okay, the position sizing and the risk controls. Okay, now what is the position sizing? So the position sizing, for example, um, let's speak about gold because I think most of you guys or most of now the liquidity in the market, it's all in the gold. Everyone is having his focus with the gold. So I think everyone now is watching the gold, right? So let's speak about the gold. This is the most popular or trending thing right now. Gold. Okay. Now, changing leverage would impact your margin, so it's good changing. Yeah. Yeah, yeah. 100%. Changing the leverage would impact your margin requirements. Yep. 100%. That's why it's not recommended to, trade with a broker who is changing your leverage without your confirmation. Okay, because at the point of time, if the leverage has changed, the margin requirement is going to change. And if this change, you might be in a drawdown and suddenly your margin becomes negative, the free margin becomes negative, and then your account is blown. It's not something in your hand, right? It's the broker who has done this, right? So let's think about this. Position sizing in no risk control. Now, the gold is reaching $5,250, right? Now, if I have a trader A and I have a trader B, okay? Now, let's assume that both persons are having $100,000 account. $100,000 account. Now, what is the suitable size for these two traders? Now, this actually, the answer, it's not gonna be same if you ask different traders. So one of the trader, he is trader A, he is a scalper. What do I mean by scalper? So for the scalper, he takes like, a trade of 5, 10 minutes maximum, maybe few minutes, and then he closes the position. So always the trader, the scalper trader, what he's doing, okay, he is just having a very tight stop loss. Okay, this is his stop loss, and he would take maybe this take profit. So it's maybe I risk $1 to have 1.5 or 1 to 2 maximum. But when it comes to this person, let's say he is a swing trader, right? His stop loss is very big and his take profit is also very big, right? So he might risk 1 to 4 or 1 to 5. He risk $1 to get $4, or he risk $1 to risk $5. Now, if these two persons are targeting a trade or taking a trade at the same time, this person, he might take smaller position. He might take a smaller position. Why? Because he would like to lose, let's say, $1,000 per trade. And this also would like to lose $1,000 per trade, right? Now, $1,000 per trade for the swing trader, and his stop loss is that huge. Let's say it's a 100 pip. Okay, so he is going to only open one lot. Okay, if it didn't go well, it's over. Now on the other side, this person he might have a stop loss of 30 pip. Okay, or like if the gold goes down like $3 here, he is having a space, more space, $10. Both of them, they are risking $1,000, right? So this person might not open a one lot. He might open 2.5 lot. He might open 2.5 what? 2.5 lot. Why? He would like to risk $1,000. Okay, but his stop loss is just $3. If the price of the gold goes down $3, I stopped out. The other person, he has a $10, okay, stop loss. So he's just gonna open $1. Both of them, they have lost a thousand, right? But this depends on your trading style. What is your trading style? Are you a type of the persons who like to take the trade for a long term and you are targeting high risk to reward ratio, like you risk $1 or 1,000 to get 4,000, or you just risk 1,000 maybe to get 1,500 and that's it. What's your style? What do you prefer? So I cannot say that the position sizing is you have to do one, two, three. I cannot also say for you that you have to risk 1% per trade. This is not correct. Guys, how many of you, the professional trader, advanced, intermediate, or even beginner, do you stick to the 1% trading risk per trade or not? Do you guys stick to the 1% or no? No way, it's more than 1% indeed. Okay. No, no, no. Now, I just want to understand why no. What's the reason? Why no? We need to understand. 2 to 3%. Okay. So here is the idea. Okay. And this is also depends on how professional you are in trading. Okay. More than one, but never more than two for proper risk management. Okay. Okay. So everyone is going to give me a different answer. Maybe 2%. Maybe I risk 5%. Some professional trader, they risk 6%, 7% per trade. It's fine. You know what makes the difference? What makes the difference here, guys, is your level of professionalism and your win rate ratio. So for example, let me just add a slide, quick slide here. Okay, so why some people they risk 1%, okay, and why some people they can risk 2, 3, even 4, or even 5% per trade. Okay, see, if you are a beginner at the beginning, like your trading journey, you're still figuring out a good strategy. You're still you're trying to manage your risk. You are trying to survive in the game without losing your capital and blowing up your account. Okay, and you still didn't find the edge. You're still not able to control your emotion. Once you lose, you would like to revenge or do trade revenge trading and so on. At that point of time, I agree with you 100%. You have to risk 1%. But what if? What if? So for the beginner level, I highly recommend this until you find your edge. So what do we mean? What do we mean by the word edge? We mean by the word edge simply. Let's assume I have a professional trader who has been in the market for 8 years or 10 years. Okay. He has a very rules-based strategy. So he has rule-based strategy. This is number one. Okay. Number two, he knows when he is trading. He knows what time he is going to trade. Number three, he knows an exact pattern, okay, that happens every day. Okay, and he's targeting this pattern. Now, if all of these conditions are met with him, and he actually, his rules is met, and he stuck to the time, and he found the pattern that most probably is going to go for the place or the direction that he's aiming to, why should I take a risk of 1%? This is an A plus setup. It's a high probability setup. I see it every day and I practice this setup for a long time. For 8 years, I'm seeing this. Okay? So why should I take 1%? Why shouldn't I take 4 or 5 or even 6%? Okay. So the more confident you become as a trader, okay, and you have a higher probability in this trade, maybe 90%, 80% that is gonna go into your favor, you have to increase your risk. Otherwise, if all the professional traders they are just watching the market and they know that that's a good setup and a high probability setup and they take 1%, no one is going to ever make money because you made today 1%, next day you lost, next day you lost, and then you're going to make another 1%. It's not going to work like this. Okay? I'm not motivating you to not to follow this. Just be careful. I'm saying this is only for pros who have strategy, who has timing, who has a plan, who they are trading one pattern or not a pattern. Maybe they are trading one asset class. They take one trade per day, and that's it. Okay, and they have a high win rate ratio, right? But if you're still figuring out what should be done in the market, then you should stick to the 1% plan, right? I hope this is clear for everyone and you agree with me. If you don't agree, then it's fine. Okay. Trading is definitely something negotiable. Everyone has his own perspective, right? Now, let's talk about the margin. So, what is the margin? The margin simply is, um, as I mentioned, the broker is giving you some money, right, to allow you to open the position, right? Thank you so much. Okay, to allow you to open the position. Now, this is not your money, this is the broker's money, right? Now, the broker is going to ask you to keep an amount aside as a collateral, let's say. Okay, so if you don't have this money in your account, I'm sorry, you're not gonna open this position. That's it. It's fair enough. Okay. If you don't have this money in your account, in your trading account at the moment, okay, you are not going to open the position. That's it. And this is something, it's a protection for the traders. I'm not gonna let you open it because you don't have this amount of money. Okay. The broker he's not, your enemy. Okay. I'm speaking about a good broker. The broker is just trying to protect your funds. Okay. So if you don't have that capital, why do you want to increase your leverage? Okay. And take the trade? Don't trade. That's it. Very simple. Okay. A lot of people, they come and ask me, I have $100 and I would like to trade. How come? How come you trade with $100? What are you going to do with $100? Nothing. I have a $500. Okay. Some people, they make the $500 $5,000. They risk full margin, 100% risk. Then what's the case? It's not going to last too long. Few months and they are going to blow the account. It does not work like this, right? So at least you should have a capital that you don't even need, that you are ready to lose it, okay? To relieve yourself from the pressure of loss, right? Because trading, it is something that is against the human nature. No one likes to live under pressure. Okay. And you are choosing to go to the charts and put yourself under pressure. So at least make the factors that, give you the success available at the beginning. Get that proper knowledge, master yourself, see what is your weakness points. And this is going to take time from you. If you are not a patient person, then trading is not for you. If you are not accepting losses, then trading is not for you. If there is one loss that is gonna break you for a whole week, then it's not, okay? And I'm not speaking for like this just to show off that I mastered everything. No, it took me 5 years to reach this level. So my stop loss is hit. Okay, so what should I do? Normal day, fine, right? So at the beginning, okay, I was not accepting any loss, but later on, it's fine. That's something easy, right? So how much capital do you advise? I see nothing, nothing below $1,000. Like, and you don't need it. This is the most important thing, that you don't need it. Okay? If you would like to put $100, then put $100 not to aim for profit. I don't mind that you deposit $100 and you trade with $100, right? But don't aim for profit. Don't look for people who are making thousands of dollars or maybe $900 or $500 per trade. You have to control your emotion. $100, if you would like to lose it, okay, it's fine. It's not gonna break you. However, you just need to use the $100 for learning because eventually, you are gonna lose it. Okay, $1,000. Okay, the more the capital, that gives you more confidence that I can even if I have a loss, I can have two losses on a row, and then I can, come back again. But with a low capital and you are risking too much, 2, 3%, 4%, then your capital, it does not allow you to, or it's not give you the space for a mistake. Okay. And at the beginning, you need a space for the mistakes. Okay. That's it. Just give yourself a place for the mistakes because believe me, you're not gonna be a profitable without losing. Right. So check the capital that makes you okay. Okay. As if nothing happened if you lost it. Check the money that you don't need it to pay your bills, to pay your fees, for your family responsibilities, something that you are not in need with it. Okay? And just grab a part of it and start to trade with it, right? Any sites to learn technical analysis? Okay. So I'll speak about the technical analysis. We already do some webinars for technical analysis, but the idea is anyhow, guys, just some good news for you that we are going, if you are already a client with a Pure Prime, by maybe before end of March, we are going to launch our Pure Prime Academy community, where we are going to give you three different strategies, starting from the basic level to the pro level. And every stage, we are going to give you a different strategy. You will learn technical analysis, fundamental analysis, price action, candlesticks, everything is going to be there, right? And in addition to that, there is going to be like live sessions, live trading sessions with us. Okay, we will send you the opportunities. Why did we take this trade? Why didn't we do it according to what we have learned? So we learn and we apply. It's gonna be something that is practical, not theoretical, not like other courses that is based only on theories, but it's just gonna be something practical. Okay, do you have a link for this? You can put it in the FA. Okay, yeah, sure, sure. Okay. Okay, for the technical analysis is something that is huge to understand. Okay, huge to understand. However, okay, let me tell you one thing. If I recommend it for you, for example, I said to you, go and watch the YouTube. I'm like um, um, this guiding you. Why? Because you're gonna learn trends, price actions, trends, downtrend, sideway, a lot of things, ICTs, SMCs, and IRC, and RSI, and MACD, and a lot of things. You don't need that in trading. Just keep it as a rule in your mind. In trading, the less is more. You don't need to know everything. You just need to know what you need to know, what you need to do it. That's it. If you are going to put three indicators on your screen, this is not going to help, right? If you're just going to put trends, indicators, momentums, moving averages, all of this, things on your screen, this is not going to help. This is not going to make you profitable. Okay. You just need to understand how the market actually moves demand and supply, and that's it. Do you have the calculator for margin level for gold and silver? Yes. If you go and check the PU prime, just write PU prime calculator and you will find everything there. Okay, so you will find here, you have the profit calculator, you have the margin calculator. You just choose the asset class, which is Forex, maybe metals, okay, silver, gold, and so on. And you write it and you choose the simple. This is the gold and this is the silver. You put your lot size and you choose what is your account leverage, and then it's gonna automatically calculate for you what is the margin. That's it, very simple. Okay, so we have the margin calculator on our website. Okay, all right. So a quick example on the margin. Okay, I don't want to go through the calculations a lot. Now let's assume we have an account of $1,000 and the leverage is 1 to 100. Okay, so this guy has chosen a leverage of 1 to 100. Contract size is 100,000. So we know that we have three types of contracts in Forex. We have the standard, and we have the mini, and we have the micro, right? So the one lot or the standard contract is 100,000 unit of the base currency. So this is, so Euro, USD, this is the base, what? The base currency, right? So I would like to know how much should I have in order to trade one lot. So the one lot, okay, and the contract size is a 100,000 times the price. So you should have $110,000, right? Now, you don't have the $110,000, you just have 1,000. So how could this be possible to trade? Simply take the leverage. So the leverage is 100. So 110 divided 100, it means 1,100. And your account just have what? $1,000. So at that time, you are not allowed to trade. Okay? Because the broker is telling you if you don't have in your trading account $1,100, I'm not gonna allow you to open the position. This is too risky for you, right? Okay. Yeah, definitely 100%. I need more understanding of lot size in pips. So definitely we are going to have another webinar explaining we already have explained this before, what are the lots, what are the pips, and so on. Maybe this is an intermediate or advanced level to speak about the calculations. However, the pips, if you just search on the YouTube or whatever, just write what is the pips, what is the lot. Okay, that's very simple, right? So we have contract, okay, because we are trading something called CFDs, contracts for differences. So you can buy standard contract. This is standard contract mean that you are going to buy 100,000 units of the base currency. So $1,000 is not enough to open the position. So what should you do at this case? So you have two options. Number one, either you can increase your leverage, or number two, you can change your lot size. So instead of choosing a one contract, one lot, okay, you can choose zero point 0.5. You can choose what? You can choose 0.5. Now, if you choose zero point 0.5, okay, and you do redo the calculation, you will have you should have $550 in your account. Now, this is what? This is your margin. So the margin simply is the amount that should be kept in your account to open the position. Okay? Now, if I don't have the money in my account, unfortunately, you're not gonna able to do that. So it's two things. Either you can increase the leverage, and you can only increase the leverage if you are a professional trader. Definitely, you can choose from the broker 1 to 500, but this is something that I don't recommend, right? You can choose 1,000, 1 to 2,000. It's up to you. But if you are professional, really professional, and you know exactly when to enter, go for it. If not, then you have to change your lot size to smaller size, right? Is that clear? I hope it's clear. Work, but that will be 50% of the account size with a very small room for trading direction to go to the opposite. Yeah, 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 100%. Right. So, for example, guys, here, if we go to this account, okay, that's the idea. Now, now this is the gold, okay? For example, I am as a person, I don't do the position sizing, okay? I'm done with that. I am a person who is just trading fixed positions. Okay. So for example, okay, if I have $100,000 account, okay, okay, sometimes, okay, the fixed thing for me, it's a one lot. Sometime I increase to 2 or 2.5 lots. This is the maximum for me. But when I see a good trade. For example, now I can see there is a good trade in front of me. Okay, I can see here a good support level, counter trend, impulse entries, broken the previous candle. Okay, for example. Okay, so at that time I can see, wow, that's a good opportunity. So what I will do is that I'm going to increase my lot size to 2, for example, right? And then I click buy. Okay. Now, once I click buy, I need to set up my stop loss, right? So my stop loss should go to level below the previous candle, should go to the level of previous candle because originally we are in the support level. This is a part of technical analysis. Okay, we're on support level. The previous candle was doji. Here, another bit bullish candle. This candle broke in the previous of the high candle. So I'll take my position and I'm aiming to, you know, maybe targeting, let's say, 1,000, 1,000, $2,000, and so on and so forth, right? So this is my position for now. If I'm doing this in real trading, and this is what actually I do in the market open New York session and so on. If I achieve the 1,000, $1,500, I close my trade and that's it. I don't have a daily target. Okay, I don't have a daily target. Okay, so this is, some people do it, some people do not do it. It's up to you, according to what do you prefer in trading, right? Okay, that would depend on the drawdown rules from the prop firm. How many lots do I use for $2,000 prop firm account? It depends, Martha. What do you trade? Do you trade gold or um, do you trade currencies? It depends on what do you trade? Okay. So for example, gold, if you have a $200,000 account, okay, the daily draw of 5% max. I know. Yeah, because I already have an account with FTMO of $200,000. So are you still in the exam phase or the phase phase number one or phase number two, or have you passed already? Did you pass or you are in the phases? So at that time, you just need to deal with the account as a free trial. You just need to deal with the account not as a $200,000. You need to deal with the account as just $10,000 because this is the maximum, or maybe $20,000. This is the maximum um, thing that you can lose. If you lost more than $20,000, then this is the account is gonna be blown, right? So the 180,000, it's not included, it's just 20,000. So the risk for 20,000 maximum you can use is 2 lots. Okay, if you are a professional trader, then I believe you have to increase it to 2.5, 3, or sometimes if really there is a high probability setup, you can go for 4 or 5. Okay, all good till now. Enjoying. Can P Prime account be linked to TradingView to trade from the charts? No, not at the moment. We still didn't do that. Any question, guys, so far? Any questions so far? Okay, good. Now we have something called the margin call. So what's the margin call? Now this is the margin. We calculated the margin. Now what's the margin call? So the margin call is a call before the broker, I would say, stop you from trading. Okay, because you're losing your money and you are not doing anything. You are not putting your stop loss, and you just watching your money is, going far from you and you're not doing anything. So, unfortunately, the broker has told you at the beginning, I'm not gonna let you open the position unless you have $550, sorry, $1,100 in your account. And you didn't have it. So you reduced your lot size to $550, right? Now, the margin call, it is a warning from the broker, that your equity and your used margin, okay, has reached a level which is below a certain level, right? So, for example, if the broker is giving you an 80% margin call, so what does this mean? How to calculate it? So, 80%, okay, equity used margin. What is my equity? My equity, okay, it is 550. Sorry, my used margin is 550. My equity is 1,000 times the 80%. Okay, I will get a $440. So what does this mean? Forget about the calculation. We are not doing the calculation when we open this. But if you have $1,000 in your account, okay, and the equity becomes or started to reach to the level of 440, okay, this means that you might receive a margin call, okay, from the broker. Definitely this percentage depends from or differs from another for one broker to another broker, right? Now if you are just keeping losing and you have reached 210, okay, percent from your margin requirement, okay, at that time, the broker is going to tell you two things. You have to immediately deposit the money. Otherwise, we are going to close the opened positions. Okay. So what the broker has done here is that he stopped you out of the market. Okay. You have multiple losing positions, losing positions, losing positions. And then you are just the 1,000 now actually becomes 110. Okay. Becomes 90, becomes 80. Now, till when? It cannot be zero. It cannot be zero, right? So what the broker is gonna do until it reaches a certain level, which is 20% of your margin requirement, the broker is gonna tell you bye bye, we close your positions, and then the 1,000, it's gonna be $190, $80, I don't care. Okay, so this is the stop out. Okay. How often do you have training sessions? Today is my first time. I have a lot to learn because I have blown my little account. No worries. Okay. Okay. That's very good. That Victoria, if you have blown your little account, that's good. Okay. Do you think that I didn't blow an account? I was in debt for 3 years because of trading. I've taken multiple credit cards from the banks and I put them in a trading account. I blown all of them. That's fine. Easy. That's easy. Take it easy. That's the way how you can learn. Every blown account, it's a learning for you. So it's fine. Okay, take it easy. As long as there is a webinar, just check the website. Okay, check the website. Okay, and every webinar we do it. Okay, go for it. Learn step by step on a demo account, right? then if you blow an account, don't be sad. It does not mean that trading is difficult or you're not gonna do it. It's fine. Easy. That's the easy thing. If you didn't blow your account, then I'll be wondering, what are you doing? This is not normal, right? Okay, that's cool. So, and as I mentioned for you guys, wait end of March. There is a huge launch for our community. Okay. All right. So, avoiding blowout your account. Okay. Now, here there are three things that you must do if you want to really do not blow your account. See, guys, the main idea of blowing an account, it is not because you are a bad trader. It's not because of the market. It's not because of anything. It is simply because of one simple thing, which is your psychology. And this is what is going to take time from you to learn it in when it comes to trading. Because believe me, if you want to learn a strategy in trading, easy part. If you want to understand how the market moves, easy part. If you want to know anything about ICT, SMC, demand and supply, news, how to read them, easy. Just give me 1 month. I can teach you all what you need, okay, in terms of strategy. But now let's come to the practical part. You're not going to be able. Sometimes you'll have fear of taking the trade. Sometimes you will be overconfident that I won 3 times on a row. I'm a professional now. Sometimes you are going to have the hope that the price might go into my direction and you don't put your stop loss. Sometimes you are going to feel of fear of missing out, right? So, in order to really stop your account from being blown, okay, some people they say stop loss is just made to make you a loser in the trading. Okay. Now, here I didn't put my stop loss, right? And this is a really bad mistake. It's a huge mistake. Now, this was a good setup for me, to be honest. It was a good setup, okay? And I said, if I want to put my stop loss, okay, I'm gonna put my stop loss at this area, okay, below the previous candles low. Okay, just given the spread. So I'm not gonna lose too much. I have entered from here and then it goes to my target. That's really good. I don't need more than this, right? So, okay, I didn't put my stop loss. Now, what if the price goes down to this level? I've lost. Why? Why? You say, no, 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 it's gonna flip and go back. Let it flip and go back. If it flipped and go back, then take another position. But don't let the hope gives you that the price is going to flip. Sometimes it never flip. I believe like there is one of my friends, he told me a story that he just told some people of his, colleagues buy Nasdaq or sorry, sell Nasdaq. And people started to sell, 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 sell. He told me from that time, Nasdaq has not ever made a correction downside. It was just going up. Okay. So guys, where are your stop losses? And he lost $85,000 because of that. Okay. He said it cannot ever come to this high price. It must go down. And every time it goes higher, it must go down. It didn't go down. $85,000. If you have put your stop loss and you admit that you are wrong, done. That's easy, right? Okay, so stop loss is a must. And here we can say no mental stop loss. What do I mean by no mental stop loss? I mean that please don't say if I lost $1,000, I just keep watching my phone. If I lost $1,000, then I'm gonna close. No, you're not gonna close. you're never gonna close. Okay? We need to help ourselves in trading to not to think. Did you see even if it was a demo account, okay, because I have a session, if I didn't have this webinar, I would have taken this trade actually. So once it reached to my level to 1,500 or 1,200, I closed it. Okay. It could maybe run for multiple, some peps more and give me 2,000 or 3,000, but I don't need it. Okay. For me, I'm done. Okay. So I have reached to what I want. I close. That's it. Okay. Don't be greedy, or at least take part of your profit. What could I have done? Instead of let the two lots opened, I could have closed one lot. I move my stop loss to the entry point. Okay. So I never turn my profitable day into a losing day. Right. And then keep it. If it's running, let it run. That's it. Right. But you don't lose. Move your stop loss up and look in some gains. Yes, that's it. 100%. 100%. Move your stop loss to the entry point. 50% close of my position. I'm okay. If it gives me 10,000, I'm okay. I'm more than happy. If not, over. Yeah. So trailing stop loss to the entry point, now you're not losing. Now you have detached all your emotions. Either the price might flip back and hit your stop loss, and at that time you booked your profit, you already have a profitable day, and you didn't lose anything. If it didn't flip back and you didn't hit your stop loss, you will keep having some profits from the market. So every time it goes up, you look up, you will take some profits from the market. That's it. Okay. This is one way, okay, to take it from the market. Now, stop loss is a must. Number two, position sizing is a must. Guys, if you are not able to, okay, it's impossible like to have a $1,000 and you just see that's NZD CAD or that's a USD JPY. Let me try three lot. Oh, that's too much. And then you lose. And then you go, oh, this is okay. Let's try the silver. Everyone is speaking about silver. And then you open zero point 0.5. Now, oh my God, if you have $1,000 and you open zero point 0.5 in silver, believe me, just once you click buy, okay, and the price has just flipped like $1, unfortunately, you have your account is blown over, right? Yeah, that's it. Over. Believe me, over. zero point 0.5 in silver. Now, zero point 0.5 in gold, acceptable, let's say. In silver, okay, because people think that, okay, this is a metal like gold. No, it's not. Okay, everything has its own number of units. So you need to check, right? And then don't use the full margin in your trading. Because if you do so, you cannot say to your friends that I am a trader. Don't describe yourself as a trader if you're using full margin. You can't say that I am gambling, okay? Which we don't do as a professional trader. Professional trader, we don't use full margin, okay? Full margin, it's a luck, 50-50, okay? Either your account is going to be blown or you are going to have your account times two, times three, times four. If this happens once, it's not going to happen twice. And if it happened twice, it's not going to happen for sure for the third time. This is luck, pure luck. In trading, we don't follow the luck. We have the plan, our plan, right? So that's all from my side. Thank you so much, everyone. I hope you enjoyed it. And let me know if you have any further questions. I will be happy to answer it. Yes, let me open the chat. Thanks for the webinar. Thank you. My pleasure. Thank you so much. Thank you. Thank you. Does P Prime have a lot size calculator? Yes, on the same thing. Go for the website, Brent. Go for the website and just write calculator. Okay, you will find trading calculator. You will find everything, the lot size, pips, profit and loss, everything. Thank you so much, everyone. Thank you, thank you, thank you. Thank you so much. Thank you. Let's trade some gold now. Yeah, the market is opening. Today is 28th, so we have very volatile market. Um, the Federal Reserve is there. There is a meeting, so risk management. Take care, guys. Thank you so much. Have a lovely day. Bye-bye. Can you calculate maximum loss based on percentage on this calculator? You mean the stop out? You mean the stop out print? No, percentage of, yeah. It will give you how much percentage you would like to risk from your account. So you just write 1%, 2%, 3%, and then it will do the calculation. Yeah, there is a tab for the risk percentage from the account. Yes. So Mita, you just need to enter the data, right? You just have to enter the information into the calculator. So the calculator is going to ask you what is the currency that you are trading, Euro, USD, gold, whatsoever. You write it. You write the opening position and the closing position, right? That's it. You just give the information and what you need to calculate. You need to calculate the margin, it will calculate the margin. You need to calculate the profit and loss, you will calculate it. You would like to calculate the stop out, it will calculate it. Yeah. Everything it's gonna give to you. You just need to enter to write the data. That's it. Yeah, they will share the recording for sure, 100%. Okay, guys? Yeah, I'll see you later on other webinars. Okay. If there is anyone here, guys, from Dubai or based on Dubai, we have an expo on 10th of Feb. I would like to meet you there if there is anyone here in Dubai. Okay, guys. See you later. Bye bye. Victoria, yes, definitely. If you go to the website Victoria, you will find webinars are divided into beginner, intermediate, and advanced. Yeah. Thank you, everyone. Have a lovely day. Bye bye.